Picture this. A country quietly prints trillions of dollars worth of money. No hyperinflation, no currency collapse, no economic panic. Now, picture another country trying the same thing. Its currency crashes, prices explode, the economy spirals. This isn't theory. This is happening right now. China has been expanding its money supply for decades. On paper, it should have ended badly. According to the rules everyone else is told to follow, China should have blown itself up. But it didn't. And that uncomfortable fact matters more today than most people realize. Because when people talk about money printing, they usually tell a simple story. Print too much, currency weakens, inflation rises, everything falls apart. That story works until it doesn't. China doesn't play by the same rules, not because it's smarter, not because it's immune to math, but because it built a system where money behaves differently. Most countries print money to cover mistakes. China prints money to control outcomes. That difference sounds small. It isn't. In the West, central banks react. Inflation rises, they panic. Markets fall, they intervene. Every move is defensive. China's system was designed the other way around. From the beginning, its banks aren't independent watchdogs, they're tools. Its currency isn't free-floating, it's managed. Capital doesn't move freely in and out, it's filtered. This isn't an accident, it's architecture. And once you understand that architecture, you start to see why China can do something others can't. You also start to see the cost. Because this system doesn't remove risk, it hides it. Here's where the mechanism reveals itself. When most countries print money, it escapes. It rushes into imports. It floods foreign assets. It weakens the currency almost immediately. China built walls around that exit. Chinese banks don't decide where money goes. The state does. Loans aren't mainly for consumption. They're for production, infrastructure, factories, housing, ports. So when new money appears, it doesn't chase iPhones or vacations. It pours into concrete and steel. That matters. Because inflation isn't just about how much money exists. It's about how fast that money moves. China slows the movement. Capital controls act like a pressure valve. Money stays inside the system longer than it should. Long enough to build things, long enough to absorb shock. And then there's the currency. The yuan isn't a global free-for-all like the dollar. It's managed daily. If pressure builds, China steps in, buying, selling, adjusting. This keeps exports cheap, factories running, jobs stable. It also means inflation gets exported. When China prints, the effects spread outward. Lower prices abroad, deflationary pressure on other countries. It feels like stability, but it's borrowed. Here's the uncomfortable math. For years, China recycled printed money into growth that produced real output, real roads, real apartments, real GDP. But growth slowed. And when growth slows, printed money has nowhere productive to hide. That's when the system changes character. Debt piles up. Projects stop paying for themselves. Local governments borrow just to roll old loans. This is the moment most money printing stories end badly. China hasn't collapsed yet. Because the system doesn't break loudly. It bends quietly. This is where hype collides with reality. China's system looks powerful because it delays consequences. It smooths crises instead of letting them explode. Bad debt doesn't default. It gets extended, hidden, renamed. That's the trade-off. In open economies, crashes are fast and brutal. In China, stress lingers. Empty apartments aren't written off, they sit. Zombie companies don't die, they survive on rollover loans. Printing money didn't remove risk, it stretched it across time. And time is now the enemy. China's population is shrinking, productivity growth is slowing. The old engine, building more, doesn't work forever. Each new unit of money creates less growth than the last. That's the warning signal. The system still functions because trust hasn't broken. People accept the currency. Banks follow orders. Capital controls hold. But those are political foundations, not economic ones. This is why comparisons miss the point. Other countries can't copy China's money printing without copying its controls. And copying the controls means giving up freedom, market pricing, capital mobility. China didn't find a cheat code, it accepted a different cost. The real question isn't whether China can print money safely, it already has. The question is how long a system built on delayed consequences can keep absorbing pressure before something finally gives. Because physics doesn't disappear when you slow time. It waits, and when it returns, it never asks permission.